Welcome back to another episode of Gimme Some Truth. I'm in the office with Andrew today. Thanks for coming in today, buddy.
Yeah, great to be here.
You and I talked a little bit about kind of what's going on in the markets right now. It feels different, right? I mean, I think that's a weird thing to say for advisors, but it feels a little different right now, and I think that's a sign maybe of the times. We're going to talk a little bit about that. And really about fear in the markets and why we get fearful during times like this, why this provokes that sensation of, oh my gosh, I have to do something. Anxiety goes up, stress goes up, all of those feelings that we hate start to creep into our psyche, and we haven't felt those for a little while. So we're going to talk about that, and then a plan to kind of combat that, and at least how we do it at Walker & Condon.
Yeah, I think there's a big, one of the ways to combat all of those things is having a plan.
Right.
And, I think we'll talk a little bit today about how we go about planning in markets like this.
Yeah.
Before we jump into that, I was an advisor in 2008.
Okay.
Were you?
Yeah.
You
I started in 2006. So
what is this different from that? Do you feel like? Obviously, there were some certain things going on.
It's a good question. I think that it's something we have to be a little careful with, because the idea that this is different makes us feel then that we have to behave differently, that we need to do something differently, that we need to we've never seen this before kind of thing, right?
Yeah.
So what I always like to say is it's not that it's different. These downturns, when they happen, they're different because of their causes. They're different because of their kind of the construct behind, around them. But in a lot of ways, they're very similar. And we should be very clear. We're not predicting a downturn. We're not saying it's going to happen tomorrow. What we are saying is that, as we sit here toward the end of March in 2025, the volatility has picked up. I think that by all measures, you can see that it's a more volatile period than compared to, say the last year or the year prior to that. The volatility has increased, and I think that's kind of what we're addressing today is not a prognostication of what might happen, but more of just when we get into these times, here's how we should behave.
Yeah.
Okay.
So
I think the headlines are different than 08, 09.
Yeah.
I think that the reason why is a little different. I think the, kind of what's causing the volatility is different, but what's interesting is the emotion is the same.
Yeah.
The fear is the same. Yeah. The oh my God, what should I do? That's the same.
Yeah. Yeah. Well, with that said, then let's kind of jump into, we identified kind of three areas that, there's kind of a feeling of loss of control. There's a feeling of that, like we talked about, some fear. So let's talk about what are investors feeling right now? Yeah.
I think that when we get into times like this, the fear is really caused by what you just said, and it's a great point, a loss of control. Why do people fear heights? Because they could fall. They don't feel like they're in control. There's nothing to grab onto. Why do people fear, flying in an airplane? They're not the one flying the plane. There's a control factor that makes us feel more safe in a lot of ways. Think about it. If you're driving in the passenger seat of a car versus driving the car, in a lot of ways, you're not, you feel okay, but you're a little, you know what I mean? As opposed to when you're driving, you're just driving. You're not thinking twice about it, right? Yeah. So I think that loss of control is predominant when we get into periods of time like this. And that loss of control kind of manifests itself in a few ways. One is we don't know what's going to happen tomorrow, right?
Yep.
If we're in a volatile time or we're in a falling market, we don't know how long it's going to last, right?
Yep.
So that duration, lack of duration, if you will, lack of no understanding of duration really kind of scares us. We don't know when it's going to be done. And I think the last thing and the most important thing is, what is the impact of this period of time or this event on us or on our financial plan / net worth?
Yeah. Yeah. And I think that's overarching is like, hey, what is going to happen to my plan or my retirement or my financial plan or my whatever goal they may have.
Or more specifically, that's where it should be, right? It shouldn't be on, oh my gosh, what does this, mean for, these 10 other variables? It really should be, what does it mean for you and your plan, right? Because that's really where it matters, right? Maybe not what's happening in other areas, but how does this truly affect me specifically?
Yeah.
I know that sounds kind of selfish, but that's how we have to look at it, because otherwise our head can just spin.
Yeah. Yeah. And one of the things that we talked about that kind of creates that head spinning is the 24-hour news cycle that, is emphasizing and really saturating the airwaves with, all the bad things, the, inflation, recession,
stagflation. I mean, all
job
the buzzwords.
loss. These are all the titles that they need to spin out there to get clicks and viewers. So that's one of the other things that I think we can, as part of our, our three main parts of the planning is to, kind of like take that with a grain of salt, step away from it, understand that there's an agenda driven there.
And let's be clear, we're not. It's not blaming the media. It's not saying it's their fault or they're not reporting accurately or whatever the case might be. It's simply they've proven from a psychological standpoint that we feel fear or pain or negative emotion twice as much as we do positive ones, euphoria and these things, right? It's the reason why when we have a market that we're in right now, if you look at the S&P 500, it's had 3 down years in the last 16 years, and 2 of those down years were single digits, and one of them was down less than 1%. So, I mean, we've had really 1/2 meaningful down years in the last 16. I don't think people are running around going, oh my God, this is so fantastic, right? Because we don't feel like that on the upside, but on the downside, we definitely know is the joke that we used to, not joke necessarily, but the way that we used to describe it, especially during 08, 09 when Clint and I were working together is, no client needs to be explained what a dash in front of their rate of return means. They know that's bad. They know that's bad. That doesn't need to be explained. But what's funny is if we would sit down with clients and we would say, hey, great, we had a great year. You're up 9% for the year, for example, right? One of the first questions that always gets asked is that good? In other words, they're asking because they just want to understand kind of within context, is that good, right? But if there's a dash in front of the 9%, they know that's bad, right? Yeah. We don't need to be told. And so, again, it just speaks to the fact that we feel pain and fear and negative emotion twice as much as we do positive. And frankly, that goes all the way back to the reason why we don't touch fire anymore, right? I mean, it's important for our survival to understand where fear and that can kind of keep us safe, but it also can lead to bad outcomes in the world we live in.
Yeah. So let's hop into, we mentioned at the top that we've got basically 3 approaches, three strategies to combat the fear and the anxiety that people have, investors have right now. So when and number 1, let's talk about mindfulness.
Yes.
Or being prepared. So what are, as advisors, what are we trying to accomplish with our clients as far as like how they're thinking at this time?
Yeah. So I think that's a good way to kind of kick it off, because having the right mindset, being in the right headspace is really, really important during times like volatile markets, because if we don't control that or even be intentional about trying to control that, then our head will spin and we'll go into a lot of different places, and we'll find ourselves kind of down rabbit holes or thinking about scenarios that are almost kind of a little bit could be seen as wow, that's kind of out there. But in the time of fear, they don't seem that out there. I had conversations with people in 2008 who literally wanted to bury their money in the backyard, and they were, and it was a serious conversation, and we had to talk about risk and why even that didn't eliminate risk, all it did is shifted risk. And so that mindset of knowing that, hey, it's probably going to be scarier, more volatile. I'm going to get whipsawed more in my portfolio. I'm going to see more up and down statements. Just knowing that going in it will take some of the fear away, because we're not then as surprised.
Yeah.
I think that mindset and having that as kind of the first pillar of the plan is really important.
Yeah. And understanding that in times like this, ultimately we're still trying to keep a long-term vision.
Yes.
Not like we talked about the day-to-day swings you might see or the week-to-week.
Yep.
Or we're not quite sure how long this is going to go on. But because of the plan that we have,
Yes.
We can continue to keep our eye on that long-term vision.
Yeah, I think you're exactly right. Just putting it into context, and again, that's the idea of having the right mindset is just, if we categorize it properly in our minds, then we're much better at being able to stay level-headed, stay objective, and reduce those negative emotions. And we're not saying don't be scared, don't be fearful. That's going to happen. It's kind of futile to say that.
Yeah.
It's just understanding that we're going to feel that way, but yet at the same time, within our long-term plan, we know we're okay.
Yeah. And so when we meet with our clients, they're calling us a little bit more now.
Yep.
They're asking a few more questions. And so we talk about what mindset to have. And then kind of the second step is strategically, what are we doing during these volatile times to actually affect positive change in our people's plans right now? So, we've got a couple identified. Why don't you kick it off?
Well, I think that just understanding how your money is invested is really important, right? Understanding where your money's positioned, understanding the risk tolerance that you're exposed to right now, understanding how that relates to your own personal risk profile as a person, right? Sometimes we'll look at portfolios that come from another advisor, and the prospective client has taken our risk questionnaire and they come in at a 55 out of 100, and their portfolio sits at an 87. Right. Mm-hmm. And we go, whoa, there's a big disconnect here, right? And those things can happen even more so. Whoops. Oh my gosh, Caleb's going to be upset with me. I've just almost broken it. Those things can happen because we lose sight of what an extended positive market can do to our portfolio. It grows our equities, right? It makes them a little bit outsized in our portfolio.
Yep.
It creates a scenario where we have an arguably more aggressive portfolio simply through the growth of the stocks over time, right?
Yep.
And so just taking a step back and understanding where your money's at. And then the second piece is understanding that we shouldn't, at least the way that we recommend and advise money, we shouldn't try to get out of the way of down markets. We should effectively manage through down markets by understanding where money's at, allocation, rebalancing back to that correct allocation, and then potentially even taking a look at the individual positions themselves and making sure that those fall in line with where we want to be.
Yeah.
It's just knowledge, right? It's just knowing more about our portfolio than maybe we did when the market was rolling along, just kicking out positive returns year after year.
Yeah. So kind of like recapping that, it's rebalancing.
Before I broke my computer.
Yeah.
Clint's going to be mad at me.
Some jargon terms here, right? So like rebalancing, understanding your risk profile and your risk tolerance, allocation, maybe even understanding a little bit of like, okay, this is what I actually own.
Right. What's under the hood?
And what's under the hood.
Right.
And that can help kind of alleviate that fear of loss of control. Hey, I actually know what I own. Yeah,
and a good way to kind of illustrate that, maybe even a step further, is to really realize how much do I have in equities, right, in stocks that are going to kind of go the direction that the indexes go, right? But then how much do I have in fixed income? How much do I have in alternatives? How much do I have in different places? Because just because the stock side of the market might be going through the volatility, it doesn't mean that the bond market is. It doesn't mean that the alternatives market is. It doesn't mean that some of these other areas are finding that same level of volatility. So you may actually have, a decent chunk of your portfolio in individual investments that have held the line very well. Mm-hmm. The overall portfolio might be going through some volatility, it might be falling in value, but you might have select positions in there that are actually holding the line. And if you need money in the future, that's potentially where you're going to pull from. So just because we have a volatile portfolio or gone through a volatile time or we've lost some money doesn't mean that every position within our portfolio has.
Yeah, exactly. And one of the other concepts is that, especially if you're not retired yet, so you're a pre-retiree and you're still saving.
Yes.
We can use that volatility actually in our favor in the form of dollar cost averaging.
Yeah, that's that's a good one too. The idea that should we stop investing? You hear that, from clients. What are you telling to people when they say, should I stop putting money in my 401k? Should I stop doing this? Should I stop making Roth contributions? It's a little volatile. Maybe I'll wait till things kind of get rosier. I mean, what are your suggestions at that point?
My gut reaction to that question is, well, if you're able to continue to save, like now is the time to really get maybe even to step it up, to start jamming that 401k as heavy as you can. Do you have outside opportunities to save in brokerage accounts or Roth IRAs or stuff like that? So, obviously we need more information, but my first reaction is, hey, if things are on sale, let's go shopping.
Yeah. Right. It's funny because the market is literally one of the only things that Americans won't buy when it goes on sale. I mean, we'll literally buy, and I am guilty. I'll buy anything if it's far enough on sale. But when the stock market falls 10 or 20 or 30 or 40%, we tend to run away from it as opposed to seeing it as potentially a buying opportunity. And you're exactly right. There's a lot of other factors, a lot of other variables that we need to take into consideration. It's not as simple as we're making it, but at the same time, kind of an overarching thought is if we can buy things at cheaper prices, that's better than buying something that's 20% maybe overvalued or 10% overvalued.
Yeah.
Right?
Yeah. And so again, a lot of that comes down to the mindset, and working with an advisor, helping you develop that plan.
Right.
So we've got mindset. We're talking, we talked through some of the strategic things that we're doing with our clients right now. Ultimately, what's the outcome of doing, putting this plan together for people that are our clients or people that want to reach out to talk to us about, potentially getting through a time period like this? What's the outcomes?
Yeah. Again, in the onset, have the right mindset, right? Have the right understanding where your portfolio is at, maybe make some tweaks if you need to. But then the third thing is taking that big step back and going, how does this overall affect my financial plan, my retirement plan, right? As you said earlier, kind of see the long game, right? As opposed to being fixated on what does my statement say this month? What is my balance today? What was my balance a month ago versus what it is today? Understanding the impact of your overall financial plan, because I think what a lot of people lose sight of is that most well-built financial plans will have volatility and downturns kind of built in to into the calculations, right? We're not just projecting a flat 7% guaranteed for the next 30 years. That's not how financial planning works. We're building in through Monte Carlo simulations different outcomes that take these things into consideration and can actually show us what is the likelihood of success within our plan, taking these down markets in. And even the planning software we use, we can stress test it beyond that to say, okay, what if we get a really bad year? What if we get a really bad period of time? What if inflation really gets out of control? So just taking that kind of, again, that last step to it is that looking at the big picture and really from a contextual standpoint, where does this downturn or where does this volatility leave me in my financial plan? And you know what? It might leave you in just in a fine spot. You might be okay. And so therefore the worry might be for nothing, really.
Yeah. And I think one of the more really powerful thing that happened last week is we were doing some group training together. We were actually in this retirement planning software, and I'm a visual learner, and we were looking at a client. And, they had a success of 93% or something like that. Sure. And then we isolated a couple of those, like down market 50% for 2 years.
Yep.
What happens to that 92%? It went down to like 90. And so I think that's important for investors and our clients to see, like, hey, like, because of the planning that we've done and the way we save and these other behaviors that we have, we can actually withstand a little bit of a storm here if there's a problem.
Or said another way, if you haven't done that planning, or if you're not familiar with what your plan looks like, this is the time to really have that freshened up, take a fresh look at it, and be a little bit more just informed as to what your plan ultimately says. Because if you're comfortable with it and you're comfortable with the results, it can make going through these periods of time so much more comfortable, because you're not feeling those same feelings as you would if you didn't have that information.
Yeah.
I mean, it's a time right now for data, for knowledge, for information. It's not a time to kind of just, hit the snooze button and just let another year go by. That's not really the time that we're in right now. You could have done that over the last, decade, if you will. The market's been had a pretty good, decade, right? But it kind of feels like we're coming into a period of time where you need to be a little bit more plugged into what's going on.
Yeah. Yeah, 100% agree. I think the difference, but one of the things I think about is like clients that are constantly looking at their account balances,
Yep.
right? And this could be a really stressful time right now if that's kind of how you look at your finances is the daily fluctuation.
Yeah.
But if you take the longer view and look at your plan,
Right.
versus your daily statements,
Yep.
you can actually ease a lot of that anxiety on your own.
Yeah.
But so kind of to wrap it up here, Nate, what any final thoughts on mindset, strategy, outcomes?
Yep.
What's people are going through again right now?
I really think that it's communication with your advisor. It's, again, realizing that the market has gone through just tons of period of volatility, tons of down markets, tons of recessions, relatively speaking, if you go back, 100, 150 years. It's not a new thing. It's a part of the business cycle, right? We can't have a business cycle without downturns, without volatility, without recessions. It is what kind of makes the business cycle that we all operate in function. You can't just have the up markets. And so understanding that it's a natural part of the business cycle itself, and then how does that impact you specifically? I think that's just having the mindset of if I know that my financial plan is in good shape, even with a volatile period or a downturn, I'm still okay, and I can have more confidence then, and don't feel like I have to do something simply because the market is behaving in a way that it hasn't, for the bulk of the last 10 to 15 years. Yeah. So I think that, having the conversations are good. Obviously, we're not going to cover everything and alleviate every fear as a result of this podcast, but we just really wanted to kick off the conversation and say, hey, we acknowledge, like anybody else, that it's been an interesting, first 3 months of the year in 2025. Talk to us. Reach out to us, put comments on the podcast if you have questions. Really just use us as a resource. These are the times where we want to hear from our clients. And so if you have questions, if you're feeling these ways, please reach out, because we'd love to hear you and sit down with you and talk through what your plan looks like and the impact that this might have for you. So Andrew, thanks so much for your time. And we look forward to seeing you all on another episode of Gimme Some Truth.
Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.